Broward, Chief Investment Officer here at Global Wealth Advisors, and this is the third quarter outlook. When we look at performance for the year through the second quarter, it has been a bit of a roller coaster ride. Early in the year, we saw a significant equity markets around tariff announcements, with a substantial recovery in performance in April on the news of a tariff pause. Throughout this up and down in the US, the international markets have done very well, and this is one of the big stories of the year so far. If you look at the far right column, you can see that developed international markets are up almost 20% for the first 6 months of the year, and emerging markets are up over 15%. Strengthening foreign currencies via a weak dollar and continued relative value favoring ex-US global countries added to the strong performance. Many central banks outside the US have increased rates, which has helped economic growth as well as the finance sector, and there's also been a great deal of money being put into the defense sector. All of these variables are currently still in place. You can see that performance drops off significantly from there though, mostly remaining positive. As I've touched on in the past, there have been calls for a recession for well over 2 years now. Around the time of the trade uncertainty and unknown tariff effects, we saw the probability for a recession spike up to over 65%. But with some of the policy fears subsiding, that's back down to 20%, according to Polymarket. And this is pretty low, given that recession in any given year is about 15%. We'll see that some of the economic data is softening a bit, but I don't think it matters as much about the labeling of a recession, but how long and how deep one would last. I don't feel it's something that we have to be overly concerned about at the moment. If you've been following the business news, you know that there is a continued tension between the White House and the Federal Reserve, particularly Fed Chair Jay Powell. The administration feels rates should be a lot lower, at least 1% lower on the Fed funds rate, and they want this to happen right now. The Federal Reserve doesn't think that it's as necessary for it to happen now, but agrees that rates will move lower over time. As you can see from this historical chart of Fed interest rate moves, they have moved from their recent high and are still expecting to move lower over the next 12 months. In order to do that, I believe they will cut this year and next year, getting closer to their target rate. If we look at the current yield curve, it becomes obvious what needs to be done to normalize the shape of the yield curve. Historically, the expectation is the further out you go to the right of this graph, the higher interest rate investors are going to demand because you're locking up your money for longer. Rate cuts this year have happened from the ECB, the Bank of Canada, Reserve Bank of Australia, Bank of England, Switzerland, Sweden, and so on, helping foreign equity performance. If you focus on the dark blue line, which is the Treasury yield curve at the end of June, you can see interest rates on the far left, and this is the shorter term rates, are higher than they are for the 10-year Treasury bond. The reason why this matters is multi-pronged. First, if rates move lower on the early maturities, it tends to bring down rates in general. It means lower credit card rates, mortgage rates, car loan, corporate and government borrowing rates, and so on. Interest rates moving lower will also help our fixed income allocation because as those interest rates go lower, prices move higher. It also helps the finance sector. You'd be back into a situation where banks can pay less on deposits and lend at the higher, longer term rates. As you know, more lending means more economic activity. As I've been saying for a while now, the hard, non-survey and confidence economic data remain strong. Things like growth, labor, inflation. They've softened a bit, which is pointing people to a slowdown, which certainly may happen. But again, I don't think it would be too bad. GDP is an important economic indicator that has trended around 2% for, say, 25 years, as you can see from this graph. The most recent data from the first quarter shows real GDP on a year-over-year basis at basically 2%, which is trend. The concern that some have is if you look inside the box, you can see for the first quarter itself, not year-over-year, it was negative 0.5%. Technically, 2 negative quarters in a row is a recession, but as I mentioned previously, these aren't big negative numbers. The unemployment and wage growth numbers are also something that everybody should be looking at. We are at full employment or very close to it and have been for the past few years, well under the long-term unemployment rate average of over 6%. Wage growth has come down, but has been hovering around 4%. Moving higher would show a tight labor market and cause to worry a little bit about inflation. Currently, for wage growth, we're at that long-term average. So again, I don't see any issues here with the data. Inflation is another big indicator that is concern to the government, the Federal Reserve in particular. It hasn't moved much higher given all the tariff talk and some increase in tariffs on metals and autos. Even the core inflation numbers not shown here remain reasonable, with both core CPI and core PCE being both well below 3%. So although we've seen a little uptick, again, very range bound and very manageable given what the Fed has done. As I mentioned, some of the softer data like surveys and confidence indicators are not holding up as well as the hard economic data. One of the softer pieces of data is the ISM, which is the Institute for Supply Management surveys for manufacturing and services. These are diffusion indexes, meaning that a reading over 50 means expansion and below 50 means contraction. Manufacturing has not been doing well for more than a few years, and services are right at that break point. Though these are concerns, they haven't prevented the market from moving forward, and you can see from this graph the underperformance of these indicators, but we know that the markets have rebounded and continue to make all-time highs. I mentioned the bounce back in the US equity markets earlier, and these two graphs show where we are currently. On the left, we see operating earnings for the past few years, and for 2026, analysts still have earnings increasing next year. This year was around $265 per share. Next is projected to be around $300, which is still very reasonable growth. On the right is the price to earnings ratio, or PE, for the S&P 500. And though it might be a little bit tough to tell from the size of the graphic, the average PE for the S&P 500 dropped to 18 during the pullback earlier in this year, but are back to the recent highs of 22. Which brings up the question about being overvalued currently. And the answer is I don't think so. We've seen broader participation on this rebound, not just the Mag 7, and as productivity increases, we should see margins increasing, which will allow the PEs to continue to expand and the market over time to continue to move forward. The dollar has been another big story this year. Year to date, down around 10%. The dollar has definitely been a casualty of the trade wars. The administration has talked about being comfortable with a weak dollar policy. It helps them to see a boost in exports and depresses imports. Part of the fallout from this, though, is a weak dollar continues to help foreign equities as their currencies strengthen. I don't think staying around these levels is a real issue as far as the dollar is concerned, but if we continue to see it weaken and performance drops further, it could cause us economic problems. I've added a new slide this quarter on company investment in artificial intelligence. As I've mentioned before, it's been something that the markets look forward to and are dreading simultaneously. But target spending can't be denied in the Mag 7 type of companies. The chart on the left is showing expected capital expenditures and how much of that is coming from operating cash flow. And without even digging in too far to the numbers, you can see that it starts to move exponentially over the next few years. The chart on the right is also important in showing where it's being used currently. Not surprising, information is at the top of the list, but adoption is taking place everywhere to a certain extent and will continue to do so as we move over the next 6 months. One of the biggest unknowns is the speed in which implementation of AI will take place and what it will mean to a company's bottom line and to the economy. And what we're looking at here is a breakdown in what drives growth in GDP. There are many factors, but you can boil it down to, is the workforce expanding and are those workers productive? I think the trend that we've seen over the past 5 years on the far right there, smaller growth in worker gains and larger output in workers is going to be in place for a while, particularly as AI takes away some jobs, but also helps to produce jumps in productivity. So where does this all leave us? Well, as we look at the headwinds and tailwinds over the next couple of quarters, some of the items we've discussed previously are still in place, but even more so. When I speak about the policy approach errors, there is a lot to speak about, but tariffs and trade are at the top of the list. It seems like for a while the tariff fears have subsided, but negotiations and posturing are causing the markets to continue to think twice. At the time of this taping, only 2 trade deals have been completed, the UK and Vietnam, and a framework agreement with China. I will say that it must come to a conclusion at some point before economic damage is done, and any kind of a softening or recession because of it in the coming months would cause an issue for the Republicans in next year's midterms. The same thing can be said about the unfinished wars. We've seen some ceasefires, but I get the sense we're nowhere near stopping. On the AI front, I feel that the reality, if it has been underhyped or overhyped, will be a problem for the markets. Some of the things that are working, there does seem to be a better footing in the markets, and solid performance in the second quarter has helped with investors getting back into or staying invested. We've covered some of the economic data that continues to point to a strong economy. One item not talked about too much is the fact that the passing of the administration's Big Beautiful Bill gets backdated to January 1st. And I would expect that there's going to be strong consumer spending as rebates from being overtaxed the first half of the year come back to individuals early next year. To sum up, I think if we can get through tariff negotiations with fair outcomes, maybe over the next quarter or so, and move towards peaceful resolutions in the current global conflicts, we will see good performance in many of the markets for the year, even though it'll be choppy for the next couple of months, but good performance overall for the year, and that should carry into next year. From everybody at Global Wealth Advisors, I'm Keith Sprower, and I'll speak with you next time.